Hey everybody, welcome to the Sustainability in Motion podcast, brought to you by ED4S. We focus on the fast-moving sustainability world to help the business community better understand the sustainability and environmental challenges we face. I am Orsagh, Chief Content Officer at ED4S.
Hello, I'm Nawar Alsaadi, founder and CEO of Canada Advisors and Senior Advisor to ED4S.
Today, I think we've got a real treat for you guys. We're talking to someone that, for probably both our cases, fortunately, we've known each other a long time. Jon Lukomnik. Jon has a long and storied career in the financial world. He's a former investment advisor at New York City's pension fund and co-founder of the International Corporate Governance Network, or ICGN. He's an adjunct professor at Bryn Mawr Fellow at Columbia University, and he's the co-author of many books about corporate governance and finance, with his latest, Moving Beyond Modern Portfolio Theory, which we'll be discussing today. Jon, thanks for joining us.
My pleasure. Glad to.
All right, well, let's start in 2021, that last book. You and James Hawley published Moving Beyond Modern Portfolio Theory. In the book, you talk about the limitations of MPT in the context of long-term systemic risks like climate and other long-term risks. Could you elaborate a little bit about what those limitations are of modern portfolio theory?
The book, as you know, was written in 2021. I'm pleased to say that it's still in a couple of bestseller lists. But the history of it actually goes back 20, 25 years earlier when, as you note, I was running the investment side of the New York City pension funds. Busy job. You're negotiating ISDAs, you're looking at cash flows, you're doing shortfall analysis, you're supposed to stay on top of the research, everything. A couple of people canceled on me for 2 meetings, and I realized that I had some time to think. And I realized that everything I was doing was a little bit of nonsense because I really needed some place to put $80 billion to earn a real rate of return beyond inflation forever. And this gets to the first epiphany about modern portfolio theory. It provides you no guidance whatsoever to do that. And the reason for that, and one of the limitations, is modern portfolio theory is a wonderful, powerful tool to extract the least mean variance portfolio, the best risk-return adjusted portfolio from the existing marketplace. But it says nothing about the price level of the existing marketplace. And we know from Brinson, Beerbauer, and Hood, various Ibbotson studies, that 75 to 94% of your variability in total return actually comes not from your security selection or your portfolio construction or anything that MPT teaches you about, but from the general price level of the market. And that, in turn, is dependent on the health of the economy, which in turn is dependent on the health of the environmental, financial, and social systems. That is a long prelude to say, so MPT says nothing about how to deal with systemic risk. It teaches you the math behind diversification. Diversification deals with idiosyncratic risk, Stellantis versus General Motors, Apple versus Meta. But it doesn't say anything about how, particularly over time, you're supposed to deal with returns that are linked to real-world denominated liabilities, which is the second problem with MPT. Because it assumes that market levels are exogenous, we've created this entire set of very elegant math. Beta is always 1.0, right? And we measure things against beta. We measure things against the general market because it only deals with things relative to the market itself, even though the movement of the market dwarfs the things that you're measuring relative to itself. And so what that 1.0 beta represents is very different in 2024, when we've had basically a monotonal up market, or in 2022, where basically we've had a monotonal down market. And so the problem with MPT is it's very elegant math, but it cuts off that math from the real world. We can go into the subsidiary theories that cut off the math from the real world, but it is math that's cut off from the real world.
All right, so I think building on this, Jon, and if I understand you well, in a way you're saying that MPT wants investors to focus on what they can control, or at least there's a perception that that's the only thing they should manage for, although what they don't control has a much higher potential impact on their performance. So I think what you are referring to potentially leads us into a discussion around system level investing, where you got to look at the system as a whole. So my question is, first, how does that differ or would differ from traditional approaches I would imagine MPT would fall under? And why do you think broader system level risks can only be tackled through system level investing, such as climate change or inequality?
Great question. It's sort of the MPT paradox. It's saying we are assuming that the overall market level is exogenous. And so the MPT paradox is do what you can control, but what you can control is the tail of the dog, that 6 to 25%. And I'm not minimizing that. 6 to 25% of return is material, but it's less than the 75 to 94% that you want to deal with. And the reason for that, as I said, is Harry Markowitz was working from the extant market. There was no thought of what creates up and down markets. And part of that is that investors at that time were retail investors, and they were all price takers, and you couldn't see the impact of investors very easily. Now we see it all the time. We have risk on off markets. We have index effects. We have cohort effects. These are all impacts of people making investments. But even more than that, the reality is value and risk are created in the real world. Risk to normal people is not what MPT defines risk as. MPT defines risk as volatility. What's the potential dispersion of prices around some expected return in the future? For most people, if you're offsetting a liability, it's the inability to fund that liability. It's shortfall analysis if you're a pension fund. It's inability to fund retirement if you're an individual. Value and risk are created in the real world. They're priced in the capital markets. And so I still believe in capital asset pricing models. I still believe that if there's more risk, you're going to have to pay up for it. And so what you have to do if you believe that systemic risk is not diversifiable, and it's not, it creates systematic risk, which by definition is not diversifiable, you have to go out and try to mitigate the systemic risk in the real world. That is a different conception of risk and risk mitigation than MPT's definition of risk as volatility and its mitigation through diversification of idiosyncratic risk. You can't diversify systematic risk, which stems from systemic risk like climate change or extreme income inequality, or even things like country risk. You have to go into the real world and try to mitigate those risks. And that's what people are doing. In fact, in 2021, writing Moving Beyond Modern Portfolio Theory was a really easy book to write because investors, although they didn't have the language for it and there wasn't the unified theory that the book provided, were already doing it. The question is, why were investors spending money to go mitigate climate change or lack of gender diversity or the threat of antimicrobial resistance on the health system? And basically, they were saying, we can mitigate these systemic risks through stewardship, through working with policymakers, through a host of tools, and that will improve our overall portfolio return. It may or may not improve any individual enterprise return of an individual company, but it will decrease the systemic risk and therefore lift all boats. Hard to see because everything's rising at the same time, but perfectly reasonable. And so the fact that investors were doing it in the real world meant that practice was leading theory, and it was easier for us to see it in the world of 2021 than it was for Harry Markowitz in the world of 1952, because we could see the actions of these large investors.
So we've kind of established that MPT isn't quite fit for purpose for systemic risks in the real world. How does it evolve to do that, or can it evolve to do that, or will it be, put on the dustbin of history and something else comes along that replaces it? What are your thoughts?
Critiques of the book were both a needed takedown of MPT, and boy, these guys are really respectful even as they criticize it. Because the reality is what MPT tries to do, it does well. Diversification isn't new. We traced it back to 1509 when Miguel Cervantes wrote in Don Quixote, don't put all your eggs in one basket. But what MPT does is give you the math to implement diversification. What systems level investing does is provide, in effect, a foundation where if the entire marketplace for your opportunity set, we're trying to move the entire marketplace up and to the left. In other words, less volatility, more return, and then you can apply MPT atop it. And so I don't think it's a question of MPT evolving or being consigned to the dustbins of history or being taken just as it always has been. I think it's a question of viewing different tools for different types of risk. Systems level investing that goes into the real world and tries to mitigate systemic risk should improve the overall risk return of the marketplace. And then you can use MPT atop a better risk-adjusted marketplace to extract the best possible portfolio from it. So to me, they're complementary.
Oh, that's a great answer. That makes sense.
Well, but I want to stay with the notion of how an individual, single, even institutional, no matter how large, can they move the needle on their own, moving the whole market to the left? I mean, when we open that discussion, I immediately think about a coalition of investors moving in the same direction. And I have experience with that as an activist investor. Part of my career, I used to be an activist investor. And one of the challenges with being an activist investor is the free rider problem. You're basically trying to move the needle for everyone, but you get 5% of the benefits and 95% goes to everybody else. And trying to get everybody on board with you, it's a bit like herding cats because they all have different incentives and they want to move in different directions. So I'm wondering, what's your take on getting the collective moving in that direction?
Boy, there are about 27 answers I want to give to this because, as you might imagine, it's a frequent question. First off, I do think individual investors can do things. They provide thought leadership, which then gets adopted, which is a form of collaboration, but it's sequential rather than coincidental. That being said, you're absolutely correct. Collaborative engagement in particular works better than individual engagement. There's been a series of studies. My favorite is by Elroy Dimson and Oswald Caracas out of Cambridge, that collaborative engagement works better than individual engagement. That said, and in fact, it's an attack that I get on systems level. Recently, someone wrote a paper saying, well, no one's going to do this because other people benefit. And I point out, well, actually, people are doing it already. And so when the facts are contrary to the theory, I'll take the facts, right? So in fact, there is Climate Action 100. There are antimicrobial resistance groups that are out there. There are coalitions that try to fight lack of gender diversity. And I think there are a couple of reasons that happens. It's not that the free rider problem doesn't exist. It does. But it's, number one, it's relatively small because the costs you incur in doing this relative to the massive profits of the asset management industry are relatively small. Secondly, if you are an asset owner, particularly if you are a fiduciary, what you are doing may be consistent with the wishes of your beneficial owners. Third, there are regulatory forces in place in parts of the world that encourage this. So just a simple comply or explain disclosure regulation, for instance, the Financial Reporting Council's Stewardship Code. I apologize for anyone who's hearing a siren in the background. I live in Manhattan. This is what you're going to get. The Financial Reporting Council in the UK in 2020, their stewardship code, they said for asset managers, tell us what you do in collaboration to deal with the systemic health of the financial system. And so any asset manager they could say we don't do anything. It's a free rider problem. We're glad to free ride. But, that doesn't go over well with institutions who are then putting out an RFP and doing due diligence and saying you're not carrying your weight. And so I think there are a host of responses from, look, I don't know why there isn't as much of a free rider problem, but the facts are that people do it, to people treat it as an insurance cost because asset managers get paid on assets under management. And it doesn't matter if those assets have gone up to beta or alpha. If they've gone up, they make more money. And so if I can spend a small amount on, in effect, on stewardship as a sort of insurance policy against major market declines, let's do it, to marketing reasons, to regulatory reasons. But increasingly, as more and more assets get indexed, in addition, this is seen as a differentiating factor. And you're, even if not directly, sometimes indirectly, just because what you're writing about this as thought leadership, it attracts investment and inflows. And then if you don't act in accordance with what you've said, you get caught up in charges of greenwashing and being hypocritical. And so there seem to be a number of things that minimize the free rider problem, although I am the first to admit that, yes, in theory, there is a tragedy of commons and free rider issue. But in reality, a lot of people are doing a lot of things about it. There were just 1,700 people at PRI in person in Toronto. It was fascinating to hear how much money is being spent to try to deal with systems level investing.
Actually, if I may just add something here before handing it to you, Matt. Speaking about the free rider problem, in my activist period, it never, it was there, but it never stopped me from moving forward with my activism because I still got the return I wanted to get, for myself and my clients. So the fact that other people made money as well, I wasn't going I'm not going to do it. It's, obviously, when I asked you that question, I was curious about your take on it, but I can, obviously, although it's a smaller...
Think of the free rider, Nawar, I absolutely agree with you. Think of the free rider as economically the opposite, a positive externality.
Yeah.
Right? We all talk about negative externalities, greenhouse gas emissions, whatever. It's a positive externality. If it makes sense for the enterprise on whatever cash flow basis, whatever sort of economic basis it makes sense, are people really going to stop because there's a positive externality?
Yeah, absolutely. Yeah. That's a great way to put it.
Well, we've transitioned into systems thinking and systems level investing here. So my next question kind of focuses on that. Can you share, with investors some practical steps on how they incorporate systemic thinking and systemic risk in what they do in their portfolios? And of course, they're going to ask how. What are tools out there that exist that can help them do that or don't exist and we need to see?
Well, let me just use climate change because it's the most obvious risk and the one that people are most concerned with. Bill Burkhart, with whom I teach a course at Columbia, and I just did a piece for the CFA Institute. It is available publicly. Look up my name, Bill's name, on how system level investors get to net zero, or the tools that they use to get to net zero, or to try and get on their journey to net zero, since no one's gotten there yet. And I think there are several. They come in sort of three buckets. One is investment enhancement, by which I mean these are things that many institutions do already. They have investment belief statements. They do due diligence on managers. They have stewardship. They have private equity or infrastructure programs, but they're tweaked to deal with whichever systemic risk that institution is focused on. And by the way, there are many besides climate change, and you can't do everything. And so we'll get to the second set, which is basically specific tools like setting boundaries around what you do. But if you have a stewardship and a systems stewardship view, instead of, or in addition to, the traditional stewardship, I have an underperforming company, I want to meet with the company, find out what they're doing, possibly support an insurgent, possibly not. You wind up doing things, and as Nawar said, often in collaboration, around an issue versus a company. So you'll join Climate Action 100 plus, and you'll try to deal with that. So that's stewardship. You may take an extra look at where in private equity or infrastructure or real estate in particular, you can find climate solution funds. So for instance, University Pension Plan in Ontario, their first directly underwritten private equity deal was an electrified railroad in the UK, because they view that as a climate solution as opposed to a gas-fired or coal-fired railroad or petrol run. And that the more freight and passengers that can go on electrified railroads, the better the carbon emission footprint is. Similarly with infrastructure, which is a very long-lived issue, what you're building matters. So let's call all those investment enhancement in one bucket, which is here are your traditional investment tools or enhance you. The second is how you set your goals, what you draw your boundaries are. And the third is sort of field building and things that scale. So engaging with policymakers is really important. Believe me, on climate change, the main difference is systems level investors are diversified and care about their portfolios. If you are a enterprise that is fossil fuel based, you have a different set of economic incentives. And policymakers have to hear from universal owners and systems level investors to offset the lobbying from the other side. Secondly, thought leadership, how you organize yourself, collaboration. Are you working in legally allowable ways with other investors? Because it's just, walking into the room and saying, I represent, 40 of your largest investors and we own 23% of your company is just more powerful than walking in with, I'm myself and I'm a big investor. I own 2% of your company, which usually is a big investor, but it's not the same. What thought leadership are you writing? Are you organized to make that have impact? Are you a member of PRI, ICGN, CII, Canadian Coalition for Good Governance, all those things? So there are ways that institutions can do it. The harder question, I think, is for an individual, right? And what I will say there is I don't think it's made its way to that level yet. Although the due diligence that you can do on a manager and understanding what a manager does matters. I've seen that at the institutional level, where, for instance, the McKnight Foundation interviewed all their managers and said, do you have a net zero approach? And within a year, 10% more did. But I haven't yet seen it for individuals. And I will tell you, as someone who sits on a mutual fund board, I have never gotten a letter from an individual. I think if we did, it would help. You do get institutional diligence requests, but not individual ones.
Interesting. So you're telling people to write you, the mutual fund board?
Telling people to write all mutual funds.
All of us, yes.
But I also think, I also do think that this question of policy matters. I don't understand. There's some people out there who think that somehow investing in policy don't mix. And this is almost the Tariq Fancy argument. Tariq Fancy used to be at BlackRock and said all this was greenwashing because, in his opinion, the only thing that mattered was policy. And by investors doing things, it gave policymakers a free pass. And there is this false dichotomy out there. To me, they work together. We wouldn't have had the Paris Accord had investors not supported it loudly. I actually think we need lots of solutions on climate. You need policy, certainly, probably most importantly. But you need $7 trillion to implement policy. You need new technologies to be implemented. So you need all of it. And the idea of not just that someone thinks one is more important than the other, which may or may not be true, but that because of that, you shouldn't do the others is just insane to me.
Yeah, no, that is a great point. And it's something that I've written about and I've hope others see this. All these things are complementary. They're kind of spokes on a wheel. Policy may be the biggest spoke and the most powerful one, but without NGOs pushing things, without investors pushing things, without companies improving their practices, these things don't happen. And so all of these are complementary. And we in the financial world, maybe we get big heads that we think, our efforts are the most important, but they're all complementary. So you need to work with companies, you need to work with, civil society organizations, you need to work with policymakers. And ignoring them or not speaking with them and not working with them is really, tying your hands behind your back if you're not doing that.
And that actually gets to systems level investing as well, because one of the things that systems level investing talks about is feedback loops between the real economy and the capital markets and the environmental, social, and financial systems. And these are all, if you've studied organizational theory, there's a theory of shortcuts. And so when you can directly speak to an NGO who's directly speaking with a policymaker and you know what's coming down the pike, you can adjust quicker. They can understand where capital is likely to flow better. You can get better policy, you can get better investing. And so it's just the feedback loops over time, and the times aren't that long. I actually have gotten frustrated lately when people keep on saying, well, this is a long-term problem. And, as we're talking at the beginning of November, when it's 70 degrees out in North America, and every state in the United States except for 2 is in a drought situation after 2 horrendous hurricanes at the beginning of October. No, I'm sorry, physical risk is still pretty now, not long-term. And transition risk is becoming now also.
Immediate. Yeah.
If I may, John, just take it back to the practical side, because I do think this is a bit of a bottleneck. When I was working on the pension side, I used to talk about something called kind of lateral climate risk. And what I mean is what we're doing on the left side of the portfolio might be hurting the right side of the portfolio, but we don't understand these relationships. I've had this discussion with specifically a member of our portfolio manager on fixed income who had exposure to high emitting industries. And I was telling him that you're increasing the risk on, the physical climate risk on our real estate portfolio and other areas. So conceptually, that makes sense. The problem is when you want to apply it in practice, the portfolio manager will come back to me and says, well, look, I have specific KPIs, specific performance indicators. If I don't invest in X, Y, or Z, I get a hit. And we don't know whether we're really impacting the right side of the portfolio. So what I'm trying to kind of get to is, it seems to me, a lack of data and measurements for this to tie into existing compensation, into targets, goals, to make it in a way operational. So I'm wondering whether you have an opinion on that and how we can move it from conceptual to something somebody can follow.
Yeah, I do. It's early stages on that, but it is being done. So for instance, PGGM is the investment bureau for the largest pension fund in the Netherlands. And they are moving from what they call 2D risk and return to 3D risk, return, and impact. And when you really start thinking about it, it's a massive shift, because to get to impact, you have to know what your portfolio is doing. And you don't look like traditional benchmarks anymore. And so now you get into a deeper philosophical discussion of what is a benchmark, what is appropriate diversification. When you said, how do people do it, this is another tool called self-organization. How have you organized your entity around what, including the unwritten assumptions? So if the unwritten assumptions are, we're a relative return shop and the relative return we try to beat is a cap-weighted benchmark, you're going to run up against that. If you make those assumptions explicit, you say, well, why are we a relative return shop? Why is the cap-weighted benchmark ours? You may, in fact, decide to stay there, or you may decide, I'm not really satisfied with the academic literature on that. It's almost the least worst definition, right? Maybe we should be considering some other set of things. I think that's often too big a step for people to take, Nawar, to be honest. And so what I have seen people do is almost a Hippocratic oath. First, do no harm, right? The problem with that is it often results in what people call portfolio decarbonization, particularly in public equities. And portfolio decarbonization doesn't often have any impact in the real world. So, for instance, if you tell Anadarko to get rid of a bunch of fracking facilities, and they do, but they sell them to fly-by-night individuals, this is a case that's actually happened in Pennsylvania, who then run wells badly, don't cap them when they're extinguished and leak methane. Your portfolio and Anadarko's portfolio, I think it was Anadarko, and I apologize if I have the name of the oil company wrong, are cleaner. But in fact, you've added greenhouse gases to the Earth's atmosphere. And so what you really need to do is think about, how am I going to compensate my people? And how I'm going to compensate people has to align with what is it I'm trying to do. And that's why, of all the tools, I believe that the single best one for self-organization is having an investment belief statement. Because if your investment belief statement starts at the very beginning, and I said this earlier, that, risk and return are created in the real world, price in the capital markets, that systemic risk is important, that there's no way to diversify from the systematic results of systemic risk, that leads you down a very different path than if you say, I largely believe markets are efficient. I want to play in non-efficient parts of the market. I will take bets against a market benchmark. Those are two very different paths. And of course, there are infinite number of paths you can go down. But it's worth some time sitting down and thinking specifically, what is it that we as an entity believe about making money? And what's our time frame? What's our risk tolerance? And the risk tolerance isn't just a variability tolerance. It's not just a volatility tolerance. It's, there are people who are very sensitive to reputational risks. Look, I would imagine that drug dealers and money launderers have risk tolerances. They're just different than yours and mine. They try and make a lot of money, and their risk is going to jail or getting shot by a rival gang or whatever it is, right? Or ODing if they take their own product. That's not something, those are beyond the ken. And what's happening is, in effect, we are increasingly, I think, responsible institutional investors are increasingly thinking that what is material, what are risks that we're willing to take, are changing. Look, in the early 19th century, a major source of collateral for the London interbank loan market were the lives of American slaves, right? In the year 2020, 2200, are you going to look back and say with equal amazement and disgust that in the early 21st century, a major source of collateral for the U.S. bank loan market were fossil fuel facilities? I don't know. But I do know that materiality changes over time, regulation changes over time, and it often follows what is socially acceptable. And so for your portfolio manager to say, I'm getting compensated over here, I don't care what happens over there, when he's affecting or she's affecting the entire fund because they are increasing systemic risk, seems to me to be a self-organizational problem that needs to get figured out at the CEO or board level. I can't blame the portfolio manager for doing what they're incented to do. I can blame the organization for not thinking through, what are you incenting the portfolio manager for?
Well, thanks again, John, for your time. This has been great. Before we sign off, we talked a lot about systems, and I know this is new to a lot of folks, just to give them some resources. A great primer for that most people start with is Donella Meadows' book, Thinking in Systems, who's kind of started all this years ago. But also you mentioned Bill Burkhart and his work at the Investment Integration Project. That's another great resource. We're going to be talking to Bill next. And anybody out there who wants to learn more about this, Jonn has been writing and researching for a long time. There's a lot of great stuff that he's put out there. Not just, the book we talked about today, but I encourage you to go see some of what he's done. Feel free to reach out to us all on LinkedIn and social media. We're all pretty active. And if you're interested in ED4S specifically, you can find us at ed4s.org. Take care, everybody.